Friends, I, Captain Vivek Jain, welcome you all to my 18th episode. In our earlier discussions, we have understood the analysis of the financial parameters of a company by study of various available financial statements such as balance sheet, profit and loss account, financial ratios. And when we develop interest in a company to be a part owner of it and its business, we decide to purchase its equity shares from the stock market. Purchase at what price? Now, that is the question which keeps coming to our mind. And as is inherent in our behavior, we all would like to buy anything in our lives at the correct price. And that correct price in stock market, we have learned in a previous episode, is popularly known as the intrinsic value. However, let me also inform you that experts in this subject have also cautioned that intrinsic value indeed is a noble and wise guidance for buying the equity share, but not the only factor. There are few others too which should be considered along, and that is what I am going to discuss today. Friends, please do remember that I have compiled these other factors as per the opinion of several experts in this field of investment in equity shares of good companies. So friends, I start my presentation. The other factors other than intrinsic value. The first one, adequate size of the company. For this, you have to remember and you have to probably look into the ratios or profit and loss account or the balance sheet, that the annual gross sales or revenue or market capitalization of any company should be not less than 500 crores. This is a guideline which I am giving you. You can always use your own discretion in cases of exceptions. Now, what does market capitalization means? It means the number of equity shares that the company has issued so far multiplied by the market price. The second factor, financially strong the company should be. The current ratio of the company should be at least 2.0. That is, the current assets at least twice the current liabilities. This fact you can easily get from the income and expenditure statement. The third one, debt equity ratio. It should not be more than 1:1 for manufacturing and industrial companies. In fact, some very good companies are having a debt equity ratio of nil, like Infosys, Britannia Industries, Hindustan Unilever, and many others. Some companies have a debt equity ratio ranging from 0.2 to 0.5. Some companies also who require more debt as per the nature of the business may have more than that, but still experts say that it should be more or less near to 1.1 at the most for the manufacturing companies and the industrial companies. However, there are some other nature of business like services company or public utility companies where probably the debt equity ratio may exceed this also. In those cases, the experts have given a figure of 2:1. Debt equity ratio, I'm reminding you, is the total shareholders' reserves plus the equity capital issued, which becomes the total shareholders' equity. It is compared with that. If the debt is equal to that, it is called 1:1. And if the debt is 2 times that shareholders' reserves and the equity capital issued, then it is 2:1. Now, in these two cases, we have just advised 1:1 and 2:1. There is an exception for banks, for non-banking finance companies, and housing finance companies. Because these companies, they have to take debt and issue the capital to the public, And in those cases, the debt equity ratio can be high, 5:1 or 7:1. However, you will have to probably compare the parameters of various such companies and use your discretion in those cases. The fourth factor, earnings. Earnings, that means net profit of a company. It should be a positive net profit for the past 10 years as recommended. And in any case, there should not be any loss in the last 5 years. Earnings growth, net profit growth, annual net profit growth that is, should average at least 7.5% per annum. And many good companies have much higher than this. They have given this optimum low figure. Below this, one should take that company's parameter with a pinch of salt. At least 7.5% per annum compounded annually in the past 5 years. That would mean 50% in 5 years. So in 5 years, net profit should be at least 50% more. That is, whatever the net profit was in the year 2015 ending, in 2020 ending, it should be at least 50% more, and that will work out to 7.5% per annum compounded. Number 6, dividends. Dividends that a company declares and distributes to shareholders should be uninterrupted for at least past 5 years at a reasonable dividend payout ratio. We have discussed this in the earlier episodes that a dividend payout ratio for a good company should range between 20 to 33%. Some companies may have below 20% if they are very fresh and new and they want to preserve the capital for the future growth of the company. And some companies, depending upon the industry like information technology, may have even more than 33%. Keeping those exceptions in mind, a reasonable dividend payout ratio for a manufacturing company which is reasonably well set should be between 20 to 33% of the net profit. Price earnings ratio. Price earnings ratio, current price should not be more than 15 to 30 times average EPS for the past 3 years. Price earning ratio is a factor which will definitely depend upon the nature of the industry. Some industries like fast moving consumer good, pharmaceutical industry, consumer based industries may have a higher price earning ratio. Few industries like power company, power generation company, power distribution companies, and companies of those nature may have a price earning ratio of 4, 5, or 6. Again, you will have to judge these parameters by comparing them, various companies in a particular industry and the various industries, and again use your discretion. But the guideline says that it should be within a range of 15 to 30 times of the average EPS of the past 3 years. Then one can say that the company is priced to be taken, to be purchased, and will possibly provide reasonable amount of capital appreciation in the years to come. That is why we have mentioned over here, for actual figure, industry average of the particular company may be referred to. Number 8, price to book value ratio. Current price should not be more than 1.5 to 2 times the book value. Let me remind you, book value is also termed as the net asset value of the company. The shareholders' funds, which includes the equity capital issued plus the shareholders' reserves, this total when divided by the equity capital issued gives net asset value or the book value of a share. So the current price should have a relationship with the book value, and experts have given the opinion that it should not be more than 1.5 to 2 times. This again is a very general guideline. You will have to use your discretion in some exceptional cases where it may exceed. In case it is very high, you will have to really explore the reason how as to why is it so much, maybe then you may realize that it is overpriced. And if it is very low, much lower than this, again after finding the actual reasons, which may also reflect the quality of the company, or it may give you an indication that it is underpriced. So with this guideline, you can use your own judgment. Number 9, equity to sales ratio. The gross annual sales should be at least 10 times the total equity capital of the company. Now, this, friends, is a very, very natural and obvious requirement, because if the sales is at least 10 times the equity capital, then even if the net profit is 5% or 7% or 10%, you will have a reasonable earning per share, and you can expect the share to grow, and you can expect capital appreciation. But if the sales is not as much as 10 times, also less than that, then it will be very difficult for the company to service that equity for the shareholders' benefit, so to speak. So there are many good companies which are today 100 times the total equity capital of the company, which are having the annual sales. But however, if you can spot a company at least 10 times, that is good enough. Friends, factors shown and discussed here today are additional guidelines to the reckoning of the intrinsic value of the equity share. And as such, I would suggest you to get familiarized to the relationship between them by regular analysis of different good companies. That will enable you to understand different parameters of such companies and will enhance your discretionary ability, which will allow you to take a confident decision in purchase and sell of the equity shares of your interest. Friends, in our next discussion, we shall discuss and demonstrate few companies with actual parameters that we have discussed today, along with their prevailing intrinsic values. Till then, let me remind you to ensure subscribe to this channel in case you have not done so as yet, and that will provide you with all earlier and future episodes easily on your screen. Do post your comments and queries, if any, to which I shall indeed reply. Friends, see you again soon. Have a nice day and happy investing.